I think the important first point is we've come a long way in terms of the big question, which I think is still Federal Reserve policy. So we had one rate hike baked in October last year in the market expectations. We're now at five. So we've come a long way. So I think in terms of the rate-based sell-off, which was really what we saw right at the start of this year, we've probably gone quite a bit of that journey already. The more interesting narrative for me is the one that's come out in the last week and a half, which is where actually markets are questioning economic growth, and whether that's in terms of actually cyclicals actually joining the sell-off, whether that's a flattening of the yield curve. That's a more interesting narrative. What it also does mean is that almost every sector, every stock that was starting the year, bar energy, is looking at a more attractive price point than it was before. So depending on your market view, whether you want to pick up cyclicals, whether you think this is an opportunity to buy large cap growth, small companies are trading at 20-year low in some valuation metrics. There are opportunities out there. So whilst I don't think we're at the end of the story in terms of Fed policy, we're going to have plenty of noise on that, particularly now the Fed has said they are data dependent on inflation, which is clearly what they always are. But I think that's going to put particular pressure on the upcoming inflation prints. I do think stock market valuations, particularly at the start of last week, were discounting a recessionary outcome, which is still quite unclear.
Edward, as you take a look at various parts of the market that did provide some protection in January, I mean, there were not a lot of them. Commodities, though, did provide somewhat of a safe harbor and very strong returns. But you're questioning the growth path from here. So what does it mean in terms of putting more money into commodities at this stage?
So, I mean, again, commodities are factoring two things. They're factoring the cyclical rebound that's expected. Well, they were at the start of the year because of Omicron. And then we've had a broad rally in commodities, which is part, I think, of the ongoing supply chain disruptions and uncertainties as part of the geopolitics, so in particular around Ukraine. And we've seen that play out in terms of the energy prices. I mean, what the market's saying at the moment is that if the Federal Reserve goes ahead, does a rate hike of, let's say, 5 this year, some people talk about 7, etc., there is a risk down the line that starts to bite at the same time as inflation starts to roll over in 2023, 2024. And on that backdrop, that is not an attractive opportunity for commodity prices. I think commodities, again, were very under-owned last year. We've seen periods where commodities have outperformed in 2021, but clearly also this year. We still think that the jury's still out on the transitory versus sustained inflation camp, and as a result, there'll be opportunities to trade in and out of commodities. Commodities is not something we are trying to increase our exposure to at this moment in time.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.